sorry, the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down, easily go down 30%. And it wouldn't shock me if it was down 50%. You're looking at, S&P, 2000, 2100, something like that.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. When unstable systems start to falter, the pace at which they unravel speeds up, which is why we're bringing back James Rickards to the program today, even though he was last on just a few months ago. Much of what Jim predicted when he was on back then, like accelerating disinflation, continued trade disruptions, and a Fed hell-bent on higher for longer in terms of its hawkish interest rate policy, has only built momentum since he was last here. Now, given the quickening pace of events, we thought it wise to get an audible from Jim on where he thinks things are headed next. Jim, thanks so much for joining us today.
Thanks, Adam. It's great to be with you.
Hey, Jim, it's always a pleasure. Look, as usual, a lot of questions for you. You got a lot of material for us. We'll do our best to get through it all. Let's just start, though, with the high-level question I like to ask you at the beginning of every one of these interviews. What's your current assessment of the global economy and financial markets?
Well, that's a great question, Adam, because a couple of things. Number one, there are two different things. The global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves and then they wake up to reality and they, crash, correct down. So there's a little bit of that going on. But in terms of the global economy, I think your use of the word global is very much on point, because it's often the case that, you look around the world, you've got the United States or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies, but they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So then they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But it usually, one's not doing so well and another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. Now that's rare. It's rare when, hey, China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. Well, for obvious reasons, because it affects basically everyone. But there's no life preserver. There's no, it's not like China's going to pull us all out of it with cheap exports, or Japan's going to, put the pedal to the metal in terms of, fixed asset investment, et cetera. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, that's pretty good. And, it's not good by post 1980 standards. It's not good at all by post World War II standards, but post 2008, yeah, that's not bad. But again, you have to disaggregate it, and you look at what grew. It was inventories were a big contributor, and net exports were a big contributor, and consumer durables, but fixed asset investment in particular. There was a big load of aircraft orders for Boeing, which is notoriously lumpy. They'll have a big month, blowout month, and then nothing for a couple of months, not nothing, but something very low. So when you look at that, inventories are counted as part of GDP, of course, but it's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. The stuff's arriving, and this kind of goes back to the whole supply chain breakdown of a year ago. That's what my book Sold Out was about. So you go back to, let's say, the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID. We're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumers slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022. And then here come the 3 containers. So at the exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter, but retailers, they slash prices, that 2-for-1 sales, because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. It could be cash, but now you got a bunch of stuff in the back office. And number 2, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that, like, fashion stuff goes out of fashion. Last spring's styles are not next spring styles. You still got last spring stuff. Good luck. We're getting close to spring, so you're dumping that stuff. Consumer electronics, you got an iPhone 13. Well, everybody wants an iPhone 14, whatever. I mean, you take the point. So, so piling up inventories is a very unhealthy sign. It means the retail sector is drying up, demand destruction is kicking in, costs are going up because you got to finance all this stuff, and your profit margins are going down. So I don't take a lot of comfort from that. But the other thing, Adam, and this is important, quarters, 3 months, obviously. If to the extent you can disaggregate monthly data, and there's a lot of monthly data, 2.9% annualized for the quarter, but it really slowed down in December. So it was sort of a waning type of thing. Christmas was a disaster. I mean, people bought stuff for Christmas, but way below expectations. And again, it goes back to piling up the inventory at the worst possible time. So it looks like the U.S. is going into 2023. Possibly recession started in December. If not, we expect it to start soon. But you're seeing the same thing in Europe now. Europe got a break with the weather. Obviously there's a war going on, so that's a big factor. But and natural gas prices skyrocketed, and oil prices skyrocketed again in mid 2022. They've come down, and people expected them, and I'm going to include myself, to go up again because of the winter, but the winter turned out to be pretty mild. I saw pictures of, people like kayaking around Copenhagen, it was like in t-shirts, so that was the break. That's, act of God, but it works. So they got a little bit of a break, but it doesn't mean that, all is well or they're out of the woods. And there are other things going on. China is a basket case. They're zero, they went from zero COVID, which was, it was bad public policy and bad health policy, but they did it anyway, maybe for political reasons, because Xi was trying to get through the National Party Congress in October 2022. But he did, and he's emperor for life, and the new emperor Xi. So they flipped almost on a dime. Now, there were riots beginning November 24th, 2022, pretty bad ones. People raged through cities. They tore down all these testing tents. They knocked down barricades. They hung banners. And the leadership in Beijing, they're looking at this thinking Tiananmen Square, 1989. So they just turned on a dime and said, okay, let it rip. The policy, let it rip. Okay, let everyone get infected, and we'll do the best we can. And but one of the ways you get through it is by letting it rip, and you develop what's called herd immunity. And that's what worked in North America and Europe. So China decided to let it rip. But when you look at the numbers, you're like, okay, you have 1.4 billion people. So you take a modest infection rate, meaning, like 30%, let's say, you're talking, round number, 450 million infections. And if you assume a modest mortality rate at 1/4, 1%, and that's borne out by the data, you're looking at close to 2 million dead. Now, those are on conservative assumptions. If you dial up the infection rate to closer to 50% and the mortality rate to 0.5%, now you're looking at 5 million dead. Again, round numbers. But the other difference between China and Europe and the US is that they don't have the healthcare system to deal with it. Our healthcare system, which is pretty good, was strained. Same thing in Europe. China has nowhere near the ICU units, the oxygen, the treatments, the professionals, the nurses and doctors, not even close. And when you get out to the village level, which is where most of the people still live, believe it or not, they often have nothing. And it actually is an interesting supply chain twist there, because the Chinese were more or less told, you have to self-medicate. We don't have the hospital beds for you. So they went out and stripped the shelves of ibuprofen, Tamiflu, Motrin, cough medicine, whatever they could get. The Beijing actually said, go back to TCM. Like, what's TCM? It's like traditional Chinese medicine, the herbs and teas and things like that. Well, I'm not knocking it, by the way. Some of that stuff's pretty healthy, but they're at a primitive level. They're like kind of at the Bronze Age level. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but you still have a lot of things that are not COVID. The real estate collapse, the excessive debt, the demographic decline, just the impact of top-down management when you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. And Jay Powell is probably sick. He's given 6 speeches, either post-FOMC meeting press conferences or like the Brookings Institution speech at the end of November, Jackson Hole, August 26th. He keeps saying the same thing. He says, inflation is job one, period. We're not really worried about anything other than inflation, and we're not going to rest until we get it down to 2%. And he said, we're going to have a recession. He didn't use the R word, but you don't need a decoder ring to figure that out. He said, unemployment is going to go up. And the Jackson Hole speech, he used the word pain like 5 times in one paragraph. I've been doing this for 45 years. I've never heard a Fed chairman use the word pain. He said, there's going to be a lot of pain. You're going to feel the pain. But the point is, he meant it. And they've been going down that path. So what are they trying to do? They're trying to get to something called the target rate. And you say, hey, Jim, what's the target rate? Well, I don't know what the number is, but neither does Jay Powell. Nobody knows what the number is. But the theory is the target rate is the rate at which rates are high enough that inflation comes down on its own without further rate hikes. That's the definition. So what's that number? And the Fed thinks it's 5.25. The market somehow thinks it's like 4.75, which we just got to, or maybe 5, but it's most likely 5.25, possibly higher, but I'll settle on 5.25. The Fed's not there yet. They're going to have to raise another 25 basis points in March 22nd. That's next FOMC, and again in early May. That those 2 additional 25 basis point rate hikes, in addition to what we've just seen, will get you to 5.25. And then from there, you go to the pause, and they use the word pause. And Powell's like, that could last a year, and maybe early mid 2024, we're looking at rate cuts. But we've got to get inflation under control. And it's not. I mean, inflation has come down a lot. If you it started dropping like a stone in July. Now I'm talking about CPI. The Fed uses, it can't be that simple with the Fed. They use PCE, personal consumption expenditure, core, meaning throw out food and fuel. Most people are like, what? That's what I spend most of my money on. But anyway, that's how the Fed does it. I always say if you want to understand the Fed, you can't use your mode. You have to put yourself in their minds or you're just going to get it wrong. So PCE core comes out monthly, but they do a year-over-year comparison. That's what they want to make 2%. But just using CPI, which is better known, has come from, round numbers again, 9, 8.7, 8.2, 7.5, 7.1, and now it's down, around 6 or high 6s. That's a lot. That's a lot. But you're still pretty far away from 2. So nice job so far, but you're not where you want to be. And the Fed said they're not going to rest until they get there. Now here's the Fed's, I hate to use the word conundrum, but sometimes it applies. Here's the Fed's conundrum. They're raising rates and inflation's coming down. That's clear. But what they don't know is are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have. And this is going to be part of what throws the economy into severe recession. So that's kind of what the Fed's doing and how they think about it. Now, let's go to our next Irish storyteller. This is the market. And in particular, although here we probably have to distinguish between the stock market and the bond market. Bond market's a lot smarter. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, the Fed will get the wake-up call, pivot, the famous word pivot, meaning cut rates, and that will bring the economy in for a soft landing. So this is the soft landing Cinderella, or sorry, Goldilocks, wrong fairy tale. This is the soft landing Goldilocks scenario where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks.
Yeah.
The bond market is telling a completely different story, by the way. And this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro dollar futures yield curve, German Bunds yield curve, and then, there's a million yield curves. I pick your maturity, but even you can look at the spread between 3-month Treasury bill rates and the expected 3-month Treasury bill rate 18 months forward. It's a little esoteric, but you can call that up. They're all inverted. They're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. And 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. Euro dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been inverted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad and it's going to get worse. And it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Euro dollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So so that's like a a big red siren, flashing light, whatever you want to call it. Okay, now let's get our third storyteller. Maybe I got four in this thing, but okay.
Okay, hey Jim, real quick before you move to the next storyteller, can you just comment real quickly that credit spreads have surprisingly been muted given the severity of the inversions? Can you just comment on that for a sec?
Sure. Credit spreads are kind of tagged along with the stock market. I mean, if stocks are doing well, which they are, I mean, we've had a rally, January rally. There's no, you say you can have your own opinions, but you can't have your own data. The stocks have had a pretty good month. Well, corporate bonds, which are how you do credit spreads, would tag along with that. The stocks are doing better, and companies can, refinance and borrow, et cetera. Then there's no reason why corporate bonds shouldn't rally. So I would think the spreads would come in, but it's vulnerable to the same reversal, which I'll describe in a minute about stocks.
Okay, but so I guess my question is would you expect credit spreads to start blowing out when things that'll be a key signal that okay, it's starting to get real here?
Yes, yeah, okay. In two ways. Number one, the whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot, not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. And so those spreads will blow out. And it's important to remember, back to my entry-level credit training at Citibank in the late 1970s, but they actually made us learn stuff. The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. So yes, kind of the yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They probably are at the so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut It won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, it's just right. It's because they screwed up as usual, as they've been doing since 1913. They over tightened. They didn't look at the forward indicators I described, and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. Less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped. I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not if stocks are going down, but it's kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So right now they're going down, but well, I mean, we had a recent rally, but this is the third one. We had a rally in July and early August. We had another rally in October, but they both corrected. The August rally corrected in September. The October rally corrected in November and December. And this January rally is going to correct also, maybe hard. But the Fed, again, that's not enough to get the Fed to act, but a so-called disorderly crash will. But that may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. And so I agree with the market that we're going to get a pivot, but I completely disagree. In my fairy tale, Little Red Riding Hood gets eaten by the wolf.
Okay. All right. Well, look, Jim, that was phenomenal job of storytelling, both with that fairy tale right there, but also with the progression from the Fed's view of the world to the market's view of the world to what you think is going to come. All right. So sounds like what you're saying is we should listen to Pell, meaning that there is highly likely to be more pain ahead of us here to be taken. Yep. You didn't use this word, but I'm going to put it in your mouth and you can correct me. But I think you would say that the bottom is not yet in for the bear market that got underway last year.
I agree with that. Yeah.
Okay.
Well, just to expand, not only do I agree with that, but I think the bottom could be a lot lower than even the people say recession, little correction. I think it's going to be worse.
Okay. And sorry, worse. You're applying that to the recession, you're applying it to the correction, market correction, or applying it to both?
Sorry, the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. We could be looking from the current levels. Bear in mind, we're down significantly from January 1st, 2022. In the case of the NASDAQ, the turnaround actually started in November 2021. So we're down from those levels. We've kind of maybe reach some moving average, but we're nowhere near the old highs. But that it could go down, easily go down 30%, and it wouldn't shock me if it was down 50%. You're looking at S&P 2000, 2100, something like that.
All right. All right. And that would be pain. That would qualify as pain. All right. Jim, this has been excellent so far. And what's wonderful is you've blown through a ton of my questions, which is you're the best thing to happen to an interviewer like me, because you just do my job for me, which is wonderful. Let's see here. So obviously I want to get to, okay, so, what are some ways in which people should position for what you're talking about coming? You gave us a view of that last time you were on the channel. So I just want to revisit that. But before I do, there's a couple other macro topics I want to pick your brain on, largely because these are things you write about a lot. But real quick, I guess let's stick on the recession just for 1 second, because there's the market pundit discussion, that we like to have about, okay, we think that earnings could compress by X amount, or stocks could go down to whatever. But then there's the human cost, right? Bad recessions generally come along with a lot of job losses, right? So there's a lot of economic and financial and economic pain that people take on because their stock portfolios go down or their housing prices correct, and U.S. housing market certainly seems to be committed now to correcting.
Right.
But then there's the real human cost of people losing their jobs and basically just having a loss of a damage to their future prospects, right? If you look at the employment data, the unemployment data, and the payroll data, to me, that feels almost like a fairy tale at this point in time. The actual stats that the Fed seems to be navigating by in terms of, the job market still seems super robust. There's a lot of people that have talked about the fact that some of these numbers just seem, they don't match a lot of other data sets, in the reality on the ground in a lot of companies. And I'd love to get your opinion on that. But where I'm trying to go with this is, do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions, like 08, like 01?
The answer is yes. And first of all, we're seeing it already. So, I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6 on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, a good year or a good day. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation.
Right.
What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. To say you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statute, SEC, Warren Act.
Yeah.
Yeah, exactly. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them, on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator, but we know enough right now here, kind of in early, late January, early February, we know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, by the way, Adam, you mentioned wages or the salaries. That one, I just shake my head. Everyone was like, well, real wage, no, not real. That's the point. Wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah. And inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. Although, if you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%, and has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. And it's the reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree.
Right. You're in the military. Yeah.
You're in the There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves relative to kind of a normalized number. That leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. And again, even if you allow for legitimate reasons for a lot of them, there's a big untapped labor pool. There are a lot of people who are sitting home, watching, the football playoffs and not going to the unemployment office. That's the thing. You have to go to the unemployment office online or whatever. You have to at least look at a job to be counted as unemployed. If you're not looking, you're not counted as unemployed, but you're still a person. You're still capable of working. You're just not looking, which is a very negative sign, by the way. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment.
So I'm so glad you went there. So I interviewed a guy named Nicholas Eberstadt last month, who has been ringing this warning bell about that cohort that you're talking about, that kind of like 8 to 10 million of sort of lost people of prime working age.
Right.
And he says he calls it a silent epidemic, but he says it's just toxic to culture and the productivity of a nation. Sounds like you feel the same way.
Not only, but I read Nick Eberstadt's research, and he's quoted in my book, Sold Out. So he was one of the sources I used in offering my own explanation about inflation, deflation, and the impact of the supply chain. So yeah, he's great.
Wow. Okay. Well, folks, yeah. So look, if you want to do a deep dive in that topic, folks, I'll put up a link here to the interview with Nick Eberstadt. Folks can go watch that. It's a really great, in terms of its importance, discussion. It's a very sobering topic.
Yeah, he wrote a book on it. I'm pretty shameless about promoting my own books, but I don't mind mentioning other people's books. But he's done a lot of good work on that.
Yeah. All right. Great. All right. And Jim, when you were talking, I put up a chart there showing that real wages, I think, have declined for the past 21 months straight, unbroken string here. Right. So really important. So kind of punchline of all this is people should gird for a rough year ahead. Right. Mm-hmm. That's really kind of I'm trying to suss out, is that something people need to do? What I'm hearing you say pretty clearly is the average person should pretty much assume the crash position, because there could be a threat to your income from, if you work for an employer, could be a threat to your portfolio. And we haven't really talked much about it yet, but if you're a homeowner, there's a threat to your home price, which for many people is the biggest asset they own. Correct.
But do it now. Don't wait till don't wait till the Fed figures this out, because they will be the last to know. I mean, look, seriously, Adam, by May or June, I expect everyone will be preparing for what we're talking about now. But my point is that the predictive analytic inputs would lead you to that conclusion today. Actually, would have led you to that conclusion last fall. But absolutely prepare now, because when it hits, it'll be too late. And stocks are down 30%. Like, oh, I think I'll sell. Oh no, why don't you sell now?
Yeah, and when you were talking about how companies, like the layoff wave is coming, the real layoff wave is coming, where you said companies do everything they can to not have to fire folks, right? They put all that investment in finding the people, hiring them. You do the hiring freezes first, you cut benefits and hours second, you drop contractors. But then once you realize the jig is up, you start, it's like, you're tossing whatever you can out of the balloon at that point in time, right? So to me, it sort of seems like a tree, right? Where it's getting hit with the axe, hit with the axe, hit with the axe. The tree is still standing pretty vertical, but then once you get to that critical point, it happens very fast, the actual falling of the tree, right?
That's right. Yeah.
Okay. All right. So, God, I could talk about this all day with you, Jim, but I got to move on. So I've had a number of questions from folks for you about, and I know you've done a lot of work, writing about this with your newsletter recently. But what do you see ahead? I'm going to cram several topics into one, but they're all related to money. What do you see as the outlook for the dollar this year? Folks are super interested in what you think about CBDCs. And I know you've done some recent writing on that. So what do you see ahead when it actually comes to the future of money?
Sure. The dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. I was on vacation with the family and friends, and we were in the French Alps in 2000, and the euro was 80 cents. And we go out with the two families. We couldn't spend $100 if we tried. I mean, order wine, 4-course dinner. You couldn't spend $100. It was wonderful. But then, the euro bounced back, got up to $1.60 in the kind of early 2000s. But so the dollar was that strong, and you really have to go back to 1985 to find a dollar that strong. And what happened in 1985? James Baker convened the Plaza Accord. It was basically, it wasn't the G7 strictly, but 5 major economies, Japan, Germany, a few others, to to weaken the dollar intentionally. The dollar was just way too strong, and they did. And then the Louvre Accord in 1987 was like, okay, we did it. Now let's stabilize. But that whole period of the 80s, mid 80s, 85 in particular, that's the last time the dollar was this strong. Now, dollars come off a little bit, kind of starting in October. You look at the Bloomberg Index. The Wall Street Journal has DXY. You know, the Fed has their own index. This is one I use, broad trade weighted. But I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, and then another question is, well, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There is a serious dollar shortage, and people roll their eyes. They're like, wait a second, you know, the China's dumping treasuries, you know, country Brazil's dumping treasuries. You know, people hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is, because and we can see it, but there's a reason for it. You know, I'm acquainting people with what I call the Q word, which is quadrillion. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, you know, FX forwards, you know, the whole thing, but they're all off-balance sheet. So they don't show up in, you know, conventional ratios. You got to read the footnotes, and they don't tell you that much. So, okay, that's an awful lot of swaps and derivatives. What supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay. So in a credit crunch, or going into recession, which is where we are, what do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this, you know, and I was general counsel and chief credit officer, one of the biggest government securities dealers for 10 years. And I know, you know, you walk around the floor and, you know, the guys on the repo desk or whatever, they're bargaining with their counterparties every morning. They're insisting on treasury bills. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Right. So where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them. Well, that's what's driving this. That's what will drive the dollar higher. So as
and so, sorry to interrupt, but let me just underscore this for folks that didn't quite get the significance of this. You're saying in a crisis, everybody wants US T-bills, right?
Correct.
The only way to buy a US T-bill is with US dollars. You can't buy it with euros. You can't buy it with any other fiat currency out there.
Correct.
You have to first convert whatever you have into dollars to then buy it. So the demand for dollars is the most important thing you're highlighting here.
That's exactly right. And then now you can do currency swaps. There are kind of other ways to get dollars, but they all involve risk. They all involve more off balance sheet. You just kind of, you know, deferring the problem a little bit, because at some point you got to unwind the swap. And you're basically short dollars because you had to get them. And if the dollar gets stronger, you've just lost more money, but you put it off for a few months. Now, people look at the TIC reports. That's the Treasury report of what foreign central banks and sovereign wealth funds own of the U.S. Treasury market. That's what it is. And you'll see that China's Treasury security balances are going down, India down, Switzerland down, and you're like, that means they hate the dollar. The answer is no. They love the dollar, but they're desperate. They have to get dollars to prop up their own banks. If you're the People's Bank of China, you got to prop up the Chinese banking system. If you're the Swiss National Bank, you got to prop up Credit Suisse, and et cetera. And so if you can't print dollars, which you can sell dollar securities, get the dollars, and then lend them to your own banks, who can then go out and buy the treasury bills. Another inversion that's not too esoteric. The Fed will actually give you all the treasury bills you want. All you have to do is just do a reverse repo with the Fed. You deposit your cash with the Fed, and they send you treasury bills, and it's like, can be overnight, 1 week, whatever. And at some point you unwind it, but what you usually do is just roll it over. So a phone call to the Fed will get you all the treasury bills you want. So why doesn't that solve the problem? Because if you look at auctions, treasury auction, by the way, everything we're talking about is now messed up by this debt ceiling debate, because the Treasury can't sell new bills. They can't. They can roll over, but they can't increase the bill issuance because they're at the debt ceiling
until the ceiling is lifted. Yeah,
correct. But until the ceiling was hit. So but they can issue new to roll over. When banks and primary dealers bid at treasury auctions for treasury bills, they get a certain rate. The more I pay, the lower the yield. But I can call the Fed and they'll send me some treasury bills. The rate at which the Fed will give you bills on a reverse repo basis is higher than the rate that the dealers get when they bid at auction. So why would you do that? Why would you bid at auction to get a yield that's lower than what the Fed will give you for a phone call? Mm-hmm. The answer is the Fed bills cannot be rehypothecated. They can't be used the way the dealers want. They can't send them to Deutsche Bank. But if I buy the bills at auction, I can. And so there's a liquidity preference for buying treasury bills at auction because I can pledge them to somebody else, and that's what they do. But if I do the reverse repo, I got to hang on to them because the Fed won't let me rehypothecate. And so that's why the yield to maturity at auction is lower than what the Fed will give you basically for free. But it's another one of these weird, quirky little inversions, but it tells you something. It tells you exactly what I said, which is there's a dollar shortage. And that will get worse as we go into a recession and credit losses pile up and banks get stressed and balance sheets get reduced and dealers say, it's treasury bills. And I don't even want 1 year bills. Give me a 3-week, give me a 4-week bill. That's going to drive the dollar higher against basically the euro.
Okay, so just to underscore, if you didn't like the pain that a rising dollar caused in 2022, you're probably not going to enjoy 2023 at all.
Unless you're long dollars.
Right, long dollars, and we'll get to some of the ways you could play this, but obviously Treasury yields should come down with the demand, and so if you're long the long bond, you could do well.
Right. I would expect the whole Treasury yield curve to come down a lot, but not yet. It's like, St. Augustine, make me chaste, but not yet.
Okay, great. Well, we'll get to that in just a sec when we kind of get to, what to do about all this. Real quick though, so strengthening dollar for this year, the CBD side, what's hottest on your radar for that? Because I know you've been writing about that a lot recently.
Yeah, a central bank digital currency is not a new currency. So a central bank digital dollar is a dollar. A central bank digital euro is a euro, yen, so forth. So it's not a new currency. It's a new ledger and it's a new payment channel. That's what's changed. And it's not a cryptocurrency. This is not blockchain. The ledger, they're still working it out whether the ledger is maintained by the Treasury or the Fed. The Fed could be fiscal agent for the Treasury. Those are important details, but they're still working those things out. But basically, it's a ledger-based system, 100% digital, encrypted message traffic, and it's a dollar. So what's not to like? And so the pitch for central bank digital currency, I'll refer to the dollar, but it's the same thing around the world. The pitch is, hey, I'm in an airport. I want to buy a candy bar. And I go up and I buy the candy bar and I pay for it with a credit card. And what is the retailer? How does he or she get paid? Well, they take my receivable, right? And they sell them to somebody called a merchant acquirer. Merchant acquirers go out and they just scoop up, hundreds of millions of dollars worth of credit card receivables, and they pay the merchant. So I get the candy bar. They got paid by the merchant acquirer. What does the merchant acquirer do? They deliver them to MasterCard or Visa. and MasterCard or Visa pays them. I go, okay, I got them take a spread. What does MasterCard do? They ship them out to all the banks who issue the MasterCards, and the banks pay them. And what does my bank do? Sends me a bill and I pay the bank. Okay, so it's all good, but we got 5 parties to buy a candy bar. We got me, the retailer, the merchant acquirer, MasterCard, and the issuing bank. 5 counterparties, 5 different exchanges of value, spreads all along the way. It's clunky, expensive, et cetera. And the Fed says, hey, with a central bank digital currency, Jim will have an account at the Fed, probably my bank, but same thing, a little QR code, boom. And the payment goes directly from A to B. It's like Venmo, right? With a few more zeros. So it's better, faster, cheaper. The Fed's not going to disintermediate the banks because they exist to prop up the banks, but it will be better, faster, cheaper. I think that's conclusive. Now, something else has to happen at the same time. You got to get rid of cash, because if people don't like central bank digital currencies, and I'll give you 20 reasons not to like them in a minute, but if that's your view, you just say, I'll pay cash. I'll hand the person, $5 bill, give me some change. So you got to get rid of cash, and Ken Rogoff, a Harvard professor, and others have been working on that for a long time. But getting rid of cash and pushing out the central bank digital currency go hand in hand. So I always say, if you want to slaughter pigs, you got to get the pigs in a chute and line them up and get them into the slaughterhouse. So you can't let them run around because they'll run away. If you want to slaughter sabers, you got to get them into this digital chute, into the digital slaughterhouse. But they're working on that. So now, where are we? We're in a world where there is no more cash. Maybe you have a credit card, but all the payment channels are through the central bank digital currency. What's the difference? The difference is the Fed or Treasury, again, probably the FBI, they can see what you're doing. Now, the other thing is the digital currency, the CBDC, is programmable. So what comes next? Okay, we're all in the CBDC dollar world, right? They say, oh, well, you know what? You've been buying a little too much gasoline, Jim. Looks like you've been driving up and down the East Coast. We're not going to let your card, your CBDC card, work at a gas pump for the next 10 days because you're using up too much gas. Oh, your heating bill's a little high. Oh, you need to turn thermostat down, get it down to 64 or whatever. My wife actually likes that, but I don't. So, turn your thermostat down. So we're not going to let you pay your heating bill. In other words, they can control how you spend your money, what you spend it on. It's a totalitarian system, but it's what governments like, by letting you or not letting you use it. Now, stimulus, Larry Summers, bring him into the act. Okay, Jim, you just got, $10,000 in your bank account, whatever. We're going to deduct 1% a month until it's all gone. So you better spend it, or maybe we'll deduct 5% a month. It's like a prepaid debit card or these gift cards. People buy gift cards on Amazon. They have expiration dates. A Metro card in the New York subway has an expiration date. If you buy a $50 Metro card and you don't use it up, it goes away. Well, this will happen to your bank account. So between total surveillance, forced stimulus, because if you don't spend it, we'll take it away. Negative income tax, negative interest rates, same thing, kind of. Tax payments. Well, what happens if you have like a regular job and how do you pay your taxes? Well, your employer withholds it. They send it in on Form 941. At the end of the year, you get a W-2 and says you made this much and we took out this much. You file your tax return, attach your W-2, and you reconcile with the IRS. That is not true for lawyers, doctors, accountants, consultants, professionals. And it's not true for a lot of people. It's not true for people with LLCs who have their own businesses. They don't have withholding. They got to pay their taxes. I'm not saying don't pay your taxes. I'm just saying that the government could decide, hey, lawyer Jim or Dr. Joe, whatever, we're gonna basically apply W-2 style holding to your bank account. We're just going to withhold 20% of every income. And, do your taxes. We'll send you the equivalent of a W-2. Do your taxes, reconcile. It's all good. But we're going to take it out of your bank account. We're not going to rely on you to pay your own taxes.
Right. And let me just comment on this, because this is the big issue, I know a lot of people are worried about with CBDCs like this, which is, right now the government, you can get a letter from the IRS that says, hey, we looked at your taxes. We think you owe more. You owe us X.
Sure.
Right.
Yeah.
But in the future you're talking about, they can say, we looked at your taxes. We think you owe us Y. So we just took it.
Well, they can do that. Yes, absolutely. But I was suggesting something even more, whatever, nefarious, which is it's not even about reconciling last year's tax return or 2 years ago tax return. It's real time. It's like, we're just going to take 20% out of your account every month because, you should be in a 40% bracket. You got some deductions, whatever. We'll sort it out at tax time, but we're just going to take it out every month.
Right. So like they're forcing estimated tax payments on you, and you don't really have any say in what they decide they think you owe.
Correct. This is actually thought control. And you say, well, don't they have that already? The answer is no, because MasterCard might know what I'm buying, but the government doesn't know. They got to subpoena MasterCard. They have to have a clause. It's Fourth Amendment. You got to go to a judge. You got to say, well, this guy's a terrorist or whatever, but they're calling everybody terrorist. So you have thought control, totalitarian means of basically suppressing dissent, arresting people you don't like, forced withholding taxes, forced tax assessments, negative interest rates, stimulus in the form of, if you don't spend it, we're going to take it away. Governments love this stuff. And so you say, well, I don't like any of that. I'm just going to go to cash, which is easier said than done. People say, I'm going to go to cash. Try going to your bank and withdrawing $100,000 of cash. Let me know how it works out. Right. I know what they'll do. They'll say, come back next week, make an appointment, bring your birth certificate and your social security card and 5 forms of photo ID and your passport. And you can do it, but they'll file a currency transaction report, or CTR, with the Financial Crimes Enforcement Network, FinCEN. By the way, notice the word Financial Crimes Enforcement Network. You didn't do anything wrong. It's your money, but you're going to go into a file right next to Osama bin Laden. I've been there. I used to do intelligence work with the government. I've been to FinCEN. I know how it all works. And that's if you want your cash, but they'll get rid of cash and you'll be forced into this digital slaughterhouse. And you say, well, then what can I do? And by the way, the American people, and maybe people around the world, but I'll speak of America, are extremely adaptive and extremely inventive when it comes up to new forms of money. If they really don't like the money that's out there, they will come up with new forms of money. I remember in the late 50s growing up, like 9, 10-year-old kid, there's always some, great uncle or distant cousin who was, adult would say, hey, kid, don't take any wooden nickels. What's a wooden nickel? But in the 1930s, they had wooden nickels. It was real. The Fed screwed up. There was not enough money. We were in the middle of the Great Depression, and towns and communities would get someone to make wood discs, little wood circles, and they would stamp it with, $5 or probably 5 cents in those days, a wooden nickel. But as long as people are willing to accept it, it's money good. If nobody wants it, that's different. But if you're like, hey, we're going to make up our own money supply because the government is letting us down, and they did, and wooden nickels were real. But back then you could buy a nice meal for 5 cents. What do people do today? Silver and gold. And in gold, I've always sort of talked about American Gold Eagles, 1 ounce, 1 ounce of pure gold. It's 22 karat, but you need a little copper alloy just to keep it so it doesn't wear out, which is a good thing. Had it on the old British side. But lately, I've really become a big fan of the quarter ounce American Gold Eagle quarter ounce, 8 grams basically, which was based on the British sovereign. That's what the British sovereign was. The British sovereign was not a 1 ounce coin. It was like 7.9 grams. So the quarter ounce American Gold Eagle is 8 grams. And also silver dollars. When I was a kid, on your 10th birthday, somebody would give you 10 silver dollars, which was a lot of money at the time. But silver dollars, the silver dollars were American dollars from like 1790 to, they stopped making them, I think, in the late 1960s, 68, somewhere during Vietnam. They're still around. The silver dollar today is garbage because there's so much silver in it. But the old silver dollars, if you have one today, it's worth $30. Back then it was $1. So, but the silver dollar worth, as I say, about $30, or the 8 gram gold coin worth about $500 at the market. That'll be spending money, and other people will take it. There's the U.S. civilian population can kind of go underground and get out of the digital slaughterhouse and get out of the totalitarian thought control with gold and silver coins of a certain denomination
via the precious metals, which is super cool. Two things. So one quick question I had for you, Jim, and I'm going to continue down this rabbit hole real quick, and then we're going to have to start getting near the end topic of this because I could keep you here forever. But how much of the current U.S. economy is done in hard cash? That's basically dark to the government right now. Do you have an estimate?
Yeah, it is an estimate. It's a little more than people might expect. It's
Yeah,
getting
it's not
smaller.
tiny. It's pretty big, right?
Yeah, it's like 20%. I don't have an exact number, but
Okay, but let's say it
order
is.
of
Let's say it's
magnitude.
a fifth of commerce, right?
Yeah,
This is one of the reasons why a CBDC is like a wet dream fantasy to, the authorities, because all of a sudden they now have, in theory, visibility and taxability and
right.
control of 100% of
If
transactions, right?
you have to get rid of, you have to do both. Bring out the CBDC and get rid of cash.
And get rid of cash, right? So, and if they do that, you're saying, hey, look, people are super adaptive. You look at wartime economies or, in prisons, or whatever, people always come up with their stuff. You talked about the precious metals. It's one of the reasons why people like junk silver, right? Is because, okay, these are small denominations. You actually could use these things for smaller purchases, right? The knock on gold is, a gold ounce, especially in the environment you're talking about, it's not practical for something that's really small. But precious metals, I think, really could be the solution you're talking about here. I
You're right
want to
about,
just bring up one thing, and then I'll let you
sure.
run, which is you've probably seen one of these, right?
Yeah, I
This
got a
is
few.
so this is what's called a valorum, and I'm just putting it up as an example of what could happen, right? So, there are technologies out there that let you take precious metals in, fractional gram format and create basically currency out of it, where the currency is the metal itself, right? And this could be used to buy a loaf of bread. It's a tenth of a gram of gold, so probably you'd buy several loaves with it. But it's an example of what you're talking about, where people can just be adaptive in all sorts of ways that most people aren't imagining right now.
Yeah, a tenth of a gram, it's like $5, So yeah, but people don't realize, they see those things, they think they're giving. There's actually real gold in them. Now, it's pounded. The one of the things great things about gold, the reason it's always been a form of money, it's not just because it's shiny and pretty. It's very malleable. It's very practical, and you can pound gold ultra thin, and that's what that is. I think you just showed. It's a very thin layer of gold. You say a tenth of a gram, and then there's a lamination on it. So again, it doesn't wear out. It's like putting an outlay in, but it's real gold in it.
Yeah, super cool. All right, well, folks, look, if there's interest in hearing more about new technologies like these, I know the guy that runs Valorum. Would be happy to get him on this channel for an interview if there's enough interest. If there is, let me know in the comments section below. I'm going to go to your market outlook, your investing outlook in just a sec, Jim. But real quick, I know that you, at your newsletter, have been writing a lot about the CBDC topic here. So I just want to give folks the URL. I'll reiterate it right at the end of the interview here. But folks, if you want to go get Jim's newsletter, particularly his recent writings focused on the topic that we've just been deep into here, go to wealthion.com/Rickards, and it'll take you straight to the sign up for Jim's newsletter. All right, Jim, as we start.
By the way, I
go
don't know
ahead.
if I can just say, if you become a subscriber, of course, you get future issues, but you get access to the archive. So you can go back years, and I've certainly been working on this for several years, what we've been discussing.
Awesome. Great. Thanks for clarifying that. All right. So, of course, the people that watch this channel, Jim, the big question that they, like to ask is, okay, great. If this is what the future is going to bring, and, as I said, you're predicting a pretty rough future ahead for 2023, then it's, what should I do? So if we can, let's just talk about some practical steps that people, who are looking to protect their investments. I guess I'd say probably priority number one is just don't become roadkill. And what happens from here. And then if there's opportunity to profit from some of these trends, great, let's talk about that. But you've always, since I've known you, very wisely been a big fan of diversification, which is, hey, nobody knows exactly what's going to happen. So use the power and the math of diversification to your advantage. And then recently you've said, you're holding a significant and higher than usual percentage of cash right now, just because it gives you a ton of optionality. Right. I'll let you comment on these, but you've said in terms of stocks in the past, you've liked commodity plays. You were a big fan of the major oil stocks last time we talked, but that's because oil was in the process of making a big run. Why don't I stop there, and then we'll get into bonds, gold, and anything else. But what do you think is a rational allocation right now for somebody who's at first and foremost trying not to get destroyed this year.
Yeah, and to be clear, I don't give.
Our interview with Jim will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. And if you're interested in signing up for Jim's excellent newsletter, go to wealthion.com/Rickards. And finally, if the challenging macro outlook that Jim has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks and opportunities that Jim has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Jim Rickards.